Hey everybody, George Chamberlin here. Glad to be back with you on this Monday, the 26th of September, back from a week of vacation. Always fun to get away, but always fun to get back home to San Diego. While I was away, things kind of went crazy as far as the financial markets are concerned. I picked a good week to be away because we really went through some tough times. Thought it'd be a good idea for us to talk a little bit about the stock market and the volatility that's come into play in here, because once again people get nervous when you have the kind of week that we had last week, where the Dow, the Nasdaq, the S&P 500 were all down 6% or more. The S&P 500 down 6.6%. Let's take a look at a chart here and put a few things in perspective. This goes back to over the last 5 years or so, and it kind of gives us a sense of where things were back here. This is the peak. This would have been October 2007, right around 14,000 on the Dow Jones Industrial Average. Then we kind of really fell off the chart here, got all the way down here. This is March of 2009. Now that's not that long ago, less than 3 years ago, when the Dow Jones Industrial Average went from 14,000 down to 6,547. Then we very consistently have been moving higher, a few little scares along the way, moving higher, got up to around 12,800 in here, and then we had again a pretty sharp decline here in the last couple of months, and we've pulled back to 10,700, 10,800, where we are right now. But again, put it in perspective. We're still below where we were at the all-time high, but we are way above where we were 2.5 years ago when the Dow got down to 6,547. What's the message out of all of this? What's the takeaway from this? The takeaway is nobody knows where the stock market's going, when it's going to move, how much it's going to move. So what do? You do what you're basically doing in your 401k. You dollar cost average. You take some money out of your paycheck every month, every paycheck, and you have it put into the stock market using good mutual funds, as is the case in most 401k plans. And that way you don't miss the markets. Sure, you won't miss this big decline, but you're not going to, if you're out of the market, you're going to miss the big recovery. And so if you average all of this in here, and the benefit, of course, is down here, you're buying mutual fund shares, stock shares, at a much lower price, so you're averaging the big price that you paid up here, and that allows you to benefit from the recovery. So if you can, if you've got time on your side, stay with this thing. Let time, the best tool investors have available to them, do their thing for you. Dollar cost averaging. I'm George Chamberlin. Have a good one.